Hello, everyone. Welcome back to Wall Street Silver. I'm Ivan Buyuki. Today, we have a returning guest joining us. Everybody, please give a warm welcome back to Thomas Thornton. He is the founder and president of Hedge Fund Telemetry. Thomas, how are you doing, sir?
I'm doing great. Nice to see you guys.
Well, we're glad to have you back. So let's get right into it.
So, hey, Thomas, your main uh, expertise is you do research, and just to remind the audience, you do research, and then the big hedge funds come to you for your intelligence that you figure out. You used to work in the hedge fund industry. Now you do research
Yes.
for all the big ones, correct?
Yeah, I put out a note like what I do every day internally at my hedge fund, which was about a $5 billion hedge fund I worked at. So I have been doing it, and I send it out to some big investors and a lot of small investors, and they've found me all over the world, and it's been just great.
Yeah, I mean, you've got a big following on Twitter, over 50,000 followers
Crazy.
there. And your last video on our channel, which was, I don't know, 5 or 6 months ago, really was outperformed. But I wanted to get your initial take on the gold and silver sector, our channel being primarily a precious metals channel. And I noticed you got a nice bar there behind you. Is that your, is that
Yes.
real? That's pretty
That was
impressive.
a gift. This was a gift from a client.
Nice.
You're pretty strong
it's
if you're
not-
lifting that thing up with one hand there.
Unfortunately, it's not 1,000 grams. It is a paper. I have door stopper, so but I like it. It's beautiful. So
Nice.
But what's your take on the sentiment? Because I know you do invest in some of the gold and silver stocks and the sector. What's your take on the sentiment right now?
well, what's happened over the last year has been a bunch of false starts, and it's. I'm sure you guys know it, and you've talked to a lot of people that are very frustrated that you can't get this follow through. Once you start this breakout, and all of a sudden it breaks your heart and comes back down. I think this time might be a little different, and the potential for for all the metals, the silver, copper, gold. I look at platinum, palladium; those have had big runs. I think there's a potential for future gains. The sentiment that I track is a polling service that I get the data, and it goes from, you're asked, are you bullish or bearish? And it goes from 0 to 100, and they take the percentage. And what I like to see is when sentiment gets above 50% and stays above 50%, because then that's a majority of people. And just yesterday, it got over 50%, but today's pullback will probably bring it right back down. But it's making higher lows as the sentiment and the price action. So I'm constructive. I don't have overweight positions in them. I like the miners. I'm in the silver miners, I'm in the gold miners and the copper miners, and they've had a nice run over the last few days.
What do you think's causing the sentiment to turn, to not get above there? Is it like the Russian situation and the Ukrainian situation? Do you think that's dominating the market right now, just on a daily basis?
I think there's two major negative catalysts right now, and you have the Russia-Ukraine situation, and then you have the Fed, which both of them are rather negative for risk assets. Obviously, it goes from one to another, and inflation numbers today with the PPI were just off the charts hot, and the market ignored it. And then there's some de-escalation talk going on in Ukraine and Russia, so that's what's been moving things. I think negativity will help these metals, and there's been plenty of it. And certainly, the thing that we need to see these start to make people money. And then this has been a market over the last year and a half of a lot of investors that are new, and they chase things that are already working. Mm-hmm. And so we need some new blood to come into the sector and propel it a little higher. And once you get a little, escape velocity, then we're all good. But we need these to work. And the other thing that is sort of a difference in through history is we now have crypto and Bitcoin and Ethereum and others that are taking away some of that inflation hedge mentality. And so if you didn't have crypto, gold would be, gold and silver and all these metals would be through the moon.
I want to continue with what you just said about catalysts for the Fed. And you said the Fed's strategy is probably an issue going forward. How do you see that playing out? The Fed's trying to raise rates right now and do this taper. You think they're going to be successful with this strategy, or do you think they're going to run into problems as they tighten a little bit?
Depends on what you mean by successful. Whatever happens, it's going to be a difficult situation for risk assets. The Fed has a mandate now to control inflation. And you saw that with President Biden at his January press conference. The first thing he talked about was controlling inflation. And he passed the buck and said, well, I'll let the Fed do it. That's what they got to do. And so that's their mandate. And I don't think the Fed is concerned about the equity markets or other markets right now. I think the Fed put, as they call it, for the S&P is probably 15 to 20% lower from this level where we are right now. So look, nobody's seen the Fed raise rates in an inflationary environment in their career that basically was managing money. So you have to go back and look at historically what happened. And look, I think there's going to be some transitory stuff. I don't think it's going to be like Volcker, but the Fed's got to raise rates, and other central banks have to raise rates. They have to take down some of the balance sheet and let that run off. I think that's going to be tough. And I don't think the Fed's going to be the usual Fed when the market gets a little wiggly, that they're going to step in and save the day. They may talk about it, but they're going to keep raising rates.
I'm just going to speak hypothetically. If the stock markets were to decline 30% and housing, interest rates get high enough to where the housing market starts showing a lot of stress. Let's say, new mortgage applications falls off a cliff, refinancings fall off a cliff because interest rates are now 6%, 5%, whatever the number. I saw it just recently got up to 4% on a 30-year fixed mortgage because banks are demand. If you see those types of new numbers with the markets for the stocks and the housing market just tanking, does the Fed then, all right, well, the pain point is now asset prices are collapsing. That gives them then the flexibility to ignore inflation and pivot back? Or is there like, nah, we still got to keep going and keep tightening? I mean, is there that point?
Yeah, there's definitely a point, but they have to that point is far from now. If interest rates spike higher, that's the worst case scenario. Interest rates, bonds selling off, stocks selling off, everything selling off. That is 1987. That is 2011 European debt crisis. The rate of change is going to be very important. And the other thing you should remember is the issuance of credit, from high yield to corporate to everything, over the last several years, with ultra low 0% interest rates, and in Europe, negative interest rates, which is a totally another worst idea of all time. If rates start moving higher, those credits are you're going to lose principal, and credit funds are going to lose principal, and it's going to be hard to refi that debt. It's going to be hard to retire that debt for companies. There is a real problem if rates start moving real high. I watch interest rates all day long, and I trade the bond market, and I think they're leading the move here.
I heard you also say something that you think the world is just really screwed up right now. Could you expand on that? I agree with you, but I'd like to get your thoughts on that very broad topic.
Well, it's a broad statement, but look, I'm an optimist. I love life. I love being, I have my family. I've got everything. I love walking into the world, my office every day and doing what I do. But there's a lot of imbalances in the world. And I think the imbalance is too much debt. I mean, you put there's debt fingerprints on every financial crisis. There's too much debt in the world. There's been too much stimulus. I think as a society, we're a very soft society and never been challenged. I think investors are the same way, where, oh God, we need the Fed, oh, please, Jerome Powell, cut rates, give us QE, save us, tell us something good. And I think that we need to have some, take some medicine and see some of the imbalances wear off. And look, that's never easy. That's never easy. But if you're prepared, like we're talking about now, and we will be prepared, you can come out of it unscathed. You don't need to, make, a ton of money on the downside or metals scream higher. Just save your money, protect your money, and get through a difficult period, and then look for opportunities when things settle out. That's my main message.
But what you just said, it used to be sort of a riff on what you just said, is we used to have recessions and we used to be fine with that, right? We used to think of recessions as that's an opportunity for the bad companies to die and new innovation to rise from the chaos. And but now there's so many zombie companies that are just, junk bond debt yields were just, how low were those? We're just ridiculously low yields relative to the risk of some of these companies. It's like at some point in the past, we stopped thinking recessions were part of the cycle. And and I'm old enough to remember the 90s when it was just, we're gonna have a recession, it's time. And we don't seem to say that anymore, right?
Well, the Fed, under Greenspan really became this omnipresent force that they felt like they can eliminate business cycles. And something, it's kind of like, if I was explaining it to one of my kids, I'd say it's kind of like a forest. You have forest fires that happen naturally, and trees go down and then new trees come up. They fall over in windstorms. New trees come out of that. And that's actually something for a recession, where new companies come out of recessions. You can go back and look at some companies that came out of recessions and who really benefited. Look at tech. Out of the tech recession, you had Google come out. You had Facebook emerge a few years after the tech bubble burst. And you had new technologies that happened.
Yeah.
It's okay if we have a recession. It's just people don't want a recession because they don't know what's going to happen to them. You have to be prepared. You just have to be prepared. And look, they want the Fed to come in, save the day. The Fed can't save the day if the tree, I'm bringing it back. If the tree's falling over, the Fed can't prop that tree over. It's got to fall down. Gotcha. And one other thing about junk bonds, it's kind of unnerving. A lot of the bonds that since 2015, when the energy market started to really get weak, the debt that was issued for the high yield bonds were issued without covenants. So basically covenant free. So if you're going to have, covenants are basically, it's like a flag goes up if there's a problem. If you don't have those flags and they don't go up, they have to get into a really bad near bankrupt state before anybody notices. Mm-hmm. So that's a risk as well. You don't have that security as far as a holder of
maintaining certain levels of cash relative to debt, things like that.
Oh yeah, no covenants.
Yeah, understood. Ivan, you had one.
Thomas, is your hedge fund, is it more cautious when picking a trade now because of the high inflationary pressures in the market?
Well, I will just mention, I only manage my own capital. I don't manage outside money anymore. I work for a hedge fund. I found my sanity leaving the hedge fund. But the thing that's great in this last year is that I'm a long short portfolio manager, and I have to find longs and shorts. And it's been actually, the last year has been an absolutely great year for finding shorts. And it's been a better year for finding shorts than long ideas. And I know people will say, oh my God, how can you say that? But I track the Goldman Sachs most shorted basket. They have all these baskets of from their prime broker that all their clients, you can see which stocks are the most shorted. And they publish this, and I have their charts. In the last year over year, that the most short basket is down 27 3/4. Okay, 28%. That's shorts making money going down. And if you look at the, let's go to the Qs. Where's my Qs? The triple Qs are up 4.89% year over year.
Mm-hmm.
Okay, so the shorts have been really, it's fruitful. And I'm not a short that I am angry at the company, or I'm an activist. I'm a technical trader. It's not personal. I look for things that are exhausted. I track short interest. I look for low short interest. I look for call buying at the high. All these little things, that's my secret sauce. And we've been finding a lot of really good short ideas. And the good news is we're starting to find some long ideas coming out of the rubble as well. But I don't think we're quite done going down. So yes, when this is look, I've never traded in, CPI at this high level or inflation at these high levels. It makes it a little bit more challenging, but then again, every year's got something new.
Yeah. It sounds, but you're one of those guys. If the data changes, you'll flip on a dime between long and short, right? You're
absolutely.
Your momentum and you're looking for trends, right? And your indicators.
Yeah, the indicators that I use, some that are from Tom DeMark, which tracks exhaustion signals. So basically, if something's going down and you get a signal on the bottom, it gives me confidence to be able to buy it. And if it's wrong and it doesn't work, which oftentimes that happens, at least I have an idea of where to stop out. And
understood. So
it's not flying blind.
Well, Thomas, thank you very much for joining us again. We really appreciate it. You have a lot of insight that's different than most of our other guests. Most of our other guests, generally are more precious metals oriented. But I love hearing you as a hedge fund, expert, with that background, sort of sharing your thoughts on the markets that we also care about. The Fed and precious metals. So, our audience appreciates you, and I look forward to talking to you again in the next 3 or 4 months.
Thanks. Thanks for having me. I'm an opportunist. So if I see the metals working well or trying to work, I'll take a shot on them on the long side.
Well, appreciate it.